Hey everyone, it's Jimmy again. Our website's finally live, so I'm trying to build content for the blog. I set a personal goal of doing a video a week, so hopefully this helps someone look at their situation a little differently, and or my realtor partners help a potential client who's afraid to take the leap. This is actually a scenario I ran into today when I was pre-approving a customer. So let's talk about move up buyer concerns. One of the things that I fail to do as a loan officer sometimes, and that I see our industry constantly failing at, is we talk about interest rates going up. We talk about the fact that the cost of buying a home is going up and low inventory, all the things that we think are driving consumers to make a purchase faster through pressure, are actually scaring people away, because the first thing they do isn't to call a real estate agent or a loan officer. They go to Zillow and Google and they try and figure out how much it would cost them to actually make this transaction. So this is a presentation. Hopefully it helps somebody in that scenario who's thinking about upgrading their house from 200,000 to right around 350,000. I did make two slides, one for 600, one for 350. We're not going to use the 600 today because it doesn't really apply to Indiana. So just remember, this isn't a one size fits all. And if you think you want me to look at your scenario, or you want me to look at your specific scenario, just give me a call. Okay. All right. So this is the situation. We have a client who had a home for 275,000 in value. They had a remaining mortgage balance of 146,000. Current interest rate was 3.75, and taxes and insurance were $400 a month. They were looking at homes in the $350,000 range. They had plenty of equity, so they were going to put down 25%. Their new mortgage would have been 262,500. We're going to go 5% interest rate for this slide purposes. The interest rates are actually low threes, high twos. I think I quoted 2.875 to this person in real life. But anyway, tax and insurance in the scenario will be $600. So let's break it down mathematically. Your rate's 3.75. Your original purchase price in 2014 was 200,000. That you put down 20%, so you had $160,000 original loan amount, and your estimated home value today is $275,000. The estimated home value is what, having people, look at this and say, oh man, maybe I should think about selling my house, and then they look at their mortgage statement, and just through a natural amortization, they're like, oh, I've amassed 14,000 in equity. So just through a normal amortization, even if they've refinanced once, they should be at around 146,000, which will give them equity of $129,000. Our proposed purchase is going to be $350,000, because somebody who has a home worth 275, if they look at 300, they won't find the value in that usually. So their down payment is again 25% of 87,500, and your mortgage amount will be 262,500 from their original of 160. So it's key right there. And then 5% interest rate. So this is where people, before they ever pick up the phone, run into problems. They look at their mortgage statement, they realize they pay $1,141 a month. They type in the numbers to the houses they like around that $350,000 range, and they realize their new payment would be $2,009. The $868 payment shock that they just had Google smack them in the face with, and this is where people start thinking, hey, whoa, let me take a step back here. I'm not sure I want to move. It doesn't feel like it's worth it. Should I just stay in my own home rather than move, and this is a situation Tasha and I found ourselves in. Luckily, I was in the mortgage industry, had a great mentor who just helped me look at it holistically. And this is before I got into sales, and helped me realize that I should be moving, and that there were other ways to apply the equity in the house. So we need to look at your client's scenario holistically instead of just one transaction at a time. This is where my ability as your loan advisor, and I'm using air quotes here, debt manager, come in. So let's manage your debt. Okay. And this is a regular, normal family's debts. Obviously, yours might be slightly different. Please feel free to flip Toyota for Ford or Tesla, whatever type of car you have, just put it in here. We're not driving around Rolls Royces here. $20,000 car balance, $370 payment. We all have a few credit cards, that we're paying about $165 a month on. But the big picture here is most Americans have about $40,000, $1,018 a month leaving their pocket beyond their house. If you have 2 cars, you have student loans, you have personal loans, feel free to make that work. But if you totaled everything up, that's where most Americans are sitting, is this 1,018, leaving in about $40,000 in debt. So, you know, when our clients are looking at this, or you're looking at this, you start thinking, okay, so I have principal, interest, tax, and insurance, $1,041 a month, $370 in installment debt, $648 in revolving. So today I'm paying $2,159. And if I upgraded my house to what I want or need, it's $3,027. And some people might not be able to afford that because their back end ratio is 40%, and that's beyond their comfort level, you know, and front end's still okay. It's 27%, you know, but your back end's at 40, even though you're putting down 75%, it just makes people uncomfortable. So what happens if we just pay off the Toyota? You know, well, now we're going to instantly save $209 a month, but our loan to value is going to be at 81%. Yeah, sure, we have mortgage insurance of $54 a month, and I've accounted for that, but we're still saving $660 versus the $868 if we had a 75% loan to value. Well, what happens if we pay the Visa card off? Well, now we're saving $346 for only a step up of $522. Our front end ratio goes to 29, and our back end ratio goes to 36. Let's pick it up a little bit here and pay off all the cards. You can see here that they have a front end ratio of 31% and a back end ratio of 31%, and their loan to value is 86%, and their mortgage insurance is $126. But wow, look at this, $191 a month. That's their step up. So this is great. You can step up into this new home for only $191 more a month if you paid off all of your other debt. You know, that type of increase is a lot easier to swallow. I'm sure that you or the client already were expecting some type of increase. You know, we have to work in the realm of realistic expectations, you know, so hopefully this scenario is easier for everyone, you know. Now, listen, where someone wants to, this is a scenario where someone wants to purchase a home. Hopefully this gives one of my friends a scenario where they weren't thinking about this previously. They were just looking at it transaction to transaction. And if you have been in a situation where you want to move, or where you're thinking about moving, the closer you get to the closing table, or the closer you get to making that decision, the more you hate the place you're living in, you know, the more your place bothers you. So whether it's the commute, the closet space, your bathroom, whatever it is, you start to kind of wish you were in a new place, you know. So hopefully this allows you the financial freedom to go make that decision. Just look at your situation holistically. I have a great tool here that we can use if you have any questions. Now, look, I want to point out something that some people have already been thinking. And if you haven't been thinking it, it's just important for you to understand. We are taking short-term debt and turning it into long-term debt. You're correct. But this is a situation where I'm helping someone accomplish their goals. And also, this is a scenario where people who can afford and are looking to make that step up purchase. This is not a scenario where someone doesn't have the equity or the means to buy a new house. I tell people all the time, just because you can buy a house doesn't mean you should buy a house. So to be clear, we have someone who has disposable income and is considering for a number of different reasons that they might want to buy a new step up house. As your loan advisor, it's my responsibility to help educate you on mortgages and help put you in a better financial situation. So please humor me for one more scenario. What if instead of racking up more debt and pocketing the extra savings that I saved you today, the $677, we paid that directly to your principal? Well, your loan would go from a 30-year to a 15-year, 11-month. you would reduce your payments by 169 payments. Think about that. How old are you today? And how old will you be 16 years from now? At the end of that term, 15 years, 11 months, you will have saved $66,941 in interest. More importantly, and here is the big payoff, your net worth will increase by $202,264, meaning that you will owe $202,264 less than you would if you made normal payments on that loan. Now, that's enough people to set them up. That's enough to set people up for retirement or put a few kids through college. Hopefully, though, you recognize that this slide is here to show you that it's the term, it's long term. You know, a 30-year mortgage is what's taking away your equity. So trying to pay that mortgage off early is super important. And, you know, also looking at this thing and looking at your debt holistically is super important. So anywho, I really hope this video helps someone in the purchase scenario who's trying to step up their purchase price. If you know anyone who's buying or selling a house, please give them my information. Also, if you think you know someone who's struggling financially and they own a home, refinances work similar to this, where they can pay off debts to you know, ease some of that pain a little bit, and I could probably help them. My cell phone number is on the screen. Visit my new website, email me. If the video sucked, provide feedback in the comments. If you liked it, please like and share it. And thank you for watching. I'm out.